Hi, my name is Amy, and thank you very much for watching. Now, let's make some bad financial decisions together. So, today I saw on Reddit that there was a big discussion about buying the dip or whether you should not buy the dip. And the argument was you really shouldn't be having a bunch of money laying around that's not invested in order to buy a dip. And for me, I think the best way to get into this is to actually define what we're talking about when we say buy the dip. Because I usually use a modified DCA, dollar cost averaging strategy, where I say I have, $500 this week to invest. So if on Monday I did $10, on Tuesday I did another $10, and on Wednesday everything crashes. I'll just put the rest of my money that I was intending to DCA in for that week into the market. And to me, 1 week of a dollar cost averaging, like that's nothing. So if it makes me feel better and I got more stocks because I got it at a cheaper price, then that works. I've also understood the buy the dip to just be like, don't panic sell. That's mostly what that saying is there for. Just if you have the money, just don't panic sell. I think where this enters bad financial decision territory is if you wake up on a Wednesday and the market is bloody red and you were just so excited for it, do not put money that you were not intending to invest into the stock market, because you have not done your budget. You've not looked into anything. You've not looked at what if you go on emotion and you wind up investing things you actually needed that money for in a relatively soon horizon, then there is a greater chance of losing money. On a grand horizon of 20 plus years, even if you invested in VU the day before a huge crash that was like 50%, in 20 years, you will be better off than if you had just stuck your cash under a mattress. So it's just, I do think that lump sum investing, like if you have $10,000, just stick it into the stock market. Time in the market beats timing the market. Most people don't have $10,000. They're not that lucky that they just got it inherited and it just appeared one day. They don't save up to have a lump sum, just dollar cost average, and make sure that you have a plan. And if the plan is, I'm going to keep 5% in a money market account, and from that money market account, I will invest $500 a month, and I'm going to replenish the money market account with new money. So it's like I'm DCAing with $500, but you're just keeping an amount in cash in case there is a dip. Or if you're using margin, it's an amount that if everything really does go south, you won't get your margin called and you'll have that risk mitigation. But I think that will work. Would that money in cash have been better deployed just in the stock market? Probably, but if it makes you feel safer, then there is some merit to that. And it does feel good to have money in order to buy the dip. But does that outweigh the actual, you would have had more money if you had just invested in the first place? That is not for me to decide. One strategy is, and this is something I came across when I was looking at leveraged ETFs like UPRO or TQQQ. It's important with those type of funds because, they 3x it when it's good, but it's also 3x the negative. So if you're profitable, if the price of the share is above the 200 daily moving average, or whatever metric you're going to use for when is it time for me to sell, if you sell those funds and then you have the rules for yourself where you say, okay, I have made this profit. I sold 5% of that because it was profitable. Now I have to reinvest this money within the next 3 months. And so it would be like I have 5% in my money market account, but it's not like you had it there for years or a year or whatever, where you didn't have a plan to reinvest it. So I think it depends on how active you want to be with your portfolio and how literal you want to be with the advice of buy the dip. I prefer to manually dollar cost average. So for me, it's if I have an amount of money per week and it's a really good deal and I use all of my money, I just don't have any more money for the rest of the week. And to me, I understand that that's not in the long run going to get me much, but it does make me feel better. So there's always that. So I understand both sides of the coin on this one, but I think that there are strategies that can be discussed, and then there's only one truly bad outcome of this, which is panic selling. And the only other takeaway from this is make a contract with yourself, or at least think through it, write down what you want to do before you make it like a prenup of like, before I start investing, or I guess post-nup if you are already investing, in this type of situation, this is what I'm doing. In this type of situation, this is what I'm doing. And it's important to know what your entry is, like what is my dollar cost average, like what does that look like, what is the profit taking looking like, and what is my exit strategy, when is it time for me to sell, what is my time horizon, what are my final goals. And as long as you know how much money you have in order to invest, and you know when you're taking profits, and you know when you're selling, then you won't fall into these emotional traps where it's red and therefore I sell and I don't want to lose any more money, so I'm just panic selling, and that's not great. So buy the dip, as in don't panic sell, have a plan for yourself, and have fun dollar cost averaging.